The following is an update and technical analysis on Meta Platforms, a company of the technology sector and internet content and information based upon the weekly interval, larger outer layers to the entire interval realm, where we have a fundamental case both with the technical aspect of this stock and this structure. TikTok may secure an extension, or if Trump orchestrates its resurrection, Meta could potentially crack, where sending additional shockwaves through its ad revenue empire, the algorithmic beast within TikTok that siphons engagement away from Instagram Reels, Facebook Watch returns, could reignite the all-out ad dollar tug-of-war, where advertisers, always ruthless in their ROI, return on investment calculus, pivot back to TikTok's superior user retention and ultra-precise targeting, could additionally squeeze Meta's margins at the worst possible time, just as regulatory scrutiny and AI-driven content shifts force Zuckerberg's hand on cost-heavy pivots, where the market sniffs out the threat off its 50-weekly moving average, and Meta's inflated multiple, built on hopes of TikTok's demise, deflates in potential real time. We are banging on the biggest key inflection point off its 50-weekly moving average, and that has had significant historical precedence. You had a backtest off this key inflection point, broke right back out of it. That was your cue to get in for a 35% move to the upside. Broke down below that 50-week moving average here in the tier color-coded beaded moving average inflection point. Once again, nice op for a short trade setup. That was good for a 20% crash. Popped that level for a great buy opportunity. The additional move to the upside was good for 112% move on a big run. Headed into 2014, you had two additional backtests off that 50-weekly moving average. Nice whipsaw-like reaction. You had a huge consolidation phase going through all of 2015. Once again, huge coiling around that key inflection point. Pop that level, resurfaced with a great long trade setup for 47% in gains with additional backtest amongst that key inflection point. Gap down, that was your sell signal, get out. On an undercut of the 50 weekly, good for a 17% crash. Once again, you had additional sell signal. You had a pop buy signal, that was good for 17%. Backtested that 50 weekly moving average. The entirety of that move was good for a 35% crash to the downside. You get the picture. It has had very significant historical reaction. I'm backtested twice around this key inflection point. That was good for a whopping, let's call it a 74% crash off its quarterly earnings on a huge down revision off its advertising, headed into the fastest rate hike in history. Call it the 2022 bear market. And here we are, dancing amongst that key inflection point. We'll zoom into the daily interval. And these are some key big time inflection points that we are writing on here off the daily, off a major reactionary uptrend price support level with major reactionary lows really across that entire sphere there. You have nice, clean, negative, and bearish divergences beginning to construct and establish on all key technical momentum indicators, which have only expanded in scale on a much larger divergence. Where the old Wall Street adage goes, the higher the climb on the hollow legs of these divergences, only constructing big key divergences on all key technical momentum indicators here. The higher the climb on hollow legs, the harder the fall when gravity calls. And we are connecting off this, which gives me an ecstatic look and or feel of a head and shoulder. You have a triple transitioning price support mechanism around this key range. Huge volume at price profile, 597.05 price support level, in confluence of its primary uptrend price support, pivot point of the 50-day moving average. Short sellers, bear traders, they want to see a solid, validated, big time sell signal on a solid red infused breakdown below this key inflection point. That ought to issue a great sell signal and shorting opportunity at the highest order. Backtest and retest that primary reactionary price resistance level, which would gain you in for a great risk reward ratio on an unfilled and unchecked gap down below for the first target at a 10% crash in confluence of its 200-day moving average. And you have additional price support at the 494.76 round for 16% crash, 454.32 for an additional 24% crash. Bull traders, long traders need to defend this key inflection point really at all costs for the risk reward ratio, setting some stops below. I can only anticipate some margin calls and or forced liquidation, stops to go off if this level begins to break down. Bull traders want to ultimately defend this key inflection point and re-challenge the minor price downtrend resistance level with major reactionary highs really across that entire sphere. They want to pop that level, take this level out with conviction on a green infused big breakout buy signal up above to re-enter and challenge those reactionary highs up above, soaring into escape velocity. Where I believe when technicals scream nice clean divergences and fundamentals continue to align with the story where charts could manufacture the headlines, the market's reckoning could be only a matter of time, where momentum can defy logic, liquidity can delay the inevitable. But when reality catches up, when earnings disappoint, margins compress, and the tape rolls over, the dam breaks with brutal efficiency.